This is the Daily Market Rundown live from the Tradelo trading floor. It's March the 31st. Some highlights from today's show. Trump tantrums continue. Credit spreads are now widening, and we have some big data in focus this week. Good day, traders, and welcome to the final trading day of March month. It is also, of course, the end of the quarter, which means we are now at the mercy of quarter rebalancing flows. Very important to understand. What that does mean is you need to kind of throw the technical patterns out of the door because very much big institutional players are not that price sensitive today. They've got a job to do, which is they need to get flows done, and they are going to do it more often than not at the most liquid time. So think open of the cash session, think close of the cash session. That is when we are likely to see some significant flows hit the tape. So keep that in mind. It is month end. It is also, of course, a massive week in terms of context for this year. Not only do we have announcements on tariffs, we've got a number of key data points out this week, including, of course, the PMI data as well as the non-farm payrolls on Friday, as well as, of course, we have Chairman Powell from the Fed speaking. So with that in mind, let's move across and talk about our first topic for today, and it's all about those Trump tariffs. They do continue. The tantrum continues. There's a number of things that's come out of the course of this weekend. We'll talk a little bit about, of course, the tariff situation in a moment, but let's start off. Trump is pretty pissed off with Putin. Of course, we know that as part of Trump's election victory, he was very much adamant he could get a peace negotiation done very quickly. He, of course, got Ukraine on board, locked in pretty much all their mineral wealth, as well as many of their assets in Ukraine, and he's pretty much got Ukraine to agree to some form of a deal. We don't know the full details of that deal yet, but ultimately we can see Putin pushing back. Putin really just ultimately buying time or ultimately looking for more concessions, whatever it might be. The point is that Trump has come out now and said, look, unless you're going to come to the table a little bit quicker, I'm going to ultimately pressure you into a deal by sort of putting back on in place some form of secondary type tariff. So what are the implications of this? Well, we know from the first experience. I know when obviously this all began back in 22, there was a number of threats laid out, and everyone's talking about the end of the ruble and a imminent recession for the Russian economy. The reality is pretty much all of Russia's oil flow managed to find its way out into European economies, into Asian economies. So the point is these tariffs are not problematic at all, and I do suspect that, of course, President Putin knows that. So perhaps, look, Trump is expected to meet with Putin this week, and of course we're always hoping for a deal, but it does feel like perhaps this is not going to see some imminent peace deal anytime soon. Now, with that in mind, we've of course seen Europe hit particularly hard today. We can see the DAX down 2%, CAC down over 2%, FTSE MIB also down over 2%. So it is very much a bloody session in Europe, and of course if we go and have a look at oil, which we would expect to be very sensitive to this headline from Trump talking about more strength and sanctions, the result is oil is pretty much flat on the day. Okay, and that speaks volumes to ultimately what ultimately the threat is there isn't a real threat from Trump. Of course we do want that deal, but the reality is the markets are not really responding a great deal to it. Now, with that in mind, from a technical perspective, two things to point out in terms of oil. There's a very good reason I don't do too much technical analysis on oil, and that's because this 200-day moving average has been flat now for a good 6 months. When the 200-day moving average is flat, we have to be very careful because there's just no trend in the market. We can, of course, see pretty much for the entire month, we're almost flat on the entire month in the oil market, and that is, of course, despite that announcement that came out in early March about OPEC increasing the supply of oil barrels this year. Apparently they are going to follow through with it. Of course, it begs to be seen. But I think the key takeaway from this is that oil prices are marginally higher. However, keep in mind, with all this tariff news going around, with all this pricing of recession going into the markets, don't be surprised to see this oil roll over at some point. Okay, it's very much not a strong market. We're well below that 200-day moving average. You can see we've come back to retest that for the first time. Don't be surprised to see oil stage a bit of an offer at some point this week. Now, with that in mind, let's turn our topic, our second topic, which is very much about these tantrums that are coming through and the implications implications for markets. Okay, we can see there across the board, Europe getting hit pretty hard, following on from the Asian session, and of course we can see the US market is set to open down. Now, don't forget, this does follow a very aggressive sell-off move on Friday, so we did see quite a lot of hedging go into the market on Friday. And I think this is very, very important because, yes, Trump has come out and said, look, I'm going to put tariffs on everyone. I'm not going to stick to the original 19 and blah, blah, blah. But this is just more of the same. It's this sort of keep market participants guessing. Don't let anyone off the hook too easily. But one thing I want to just stress is that the market is fully hedged for these tariffs tomorrow. And we'll talk about the term structure in a minute. But right now, the market is very much hedged against these tariffs. And what that typically means is that if everyone's hedged against a negative outcome, some sort of a tariff outcome, the odds of a very nasty short squeeze are very much on today / tomorrow. So keep that in mind, okay? We've priced in a lot of this tariff news over the course of the last two sessions, and what that does mean is that shorts are quite vulnerable should we start to see a little bit of buy opportunity come back into the market, okay? Now, with that in mind, what has Trump said? Well, he hasn't said much, okay? He's basically just told us that he's going to impose tariffs on everyone rather than a list of the naughty 19, as they're called now. But don't forget, the naughty 19 at the end of the day were the biggest cheaters. Okay, so the reality is the implications, whether it was the naughty 19 or everyone, it's the same damn thing. Okay, however, the markets, the way it's moved ultimately today, is on a combination of perhaps what we heard about President Putin, or in regards to Russia, as well as of course the tariff news, as well as the fact that it is month end, and of course the markets were quite nervous heading into the weekend. Okay, so it's not like the markets are down heavy today on new news. They are down simply because we had a very aggressive sell-off on Friday. Okay, now with that in mind, gold is at record highs. Of course, we do have Europe down quite a lot, and bonds have gapped up. That is the scenario or the context into which we come into this cash session. But like I said, it's very much month-end flows today. Okay, that is the key takeaway. It's month-end flows today, and that is going to ultimately lead the flows over the course of the session. Now, in terms of that term structure, I think this is the key takeaway to stress. Okay, what we can see in terms of the implied vol over the course of today, tomorrow, Wednesday, Thursday, notice how it's significantly higher. And then when we get beyond those tariffs, of course, we've still got Friday because it's non-farm payrolls. But notice how the term structure is lower for that. And then, of course, as we move into next week, we start to see that flatten out. Okay, that's very typical. It shows us that the market is hedging itself against whatever comes out this week. And what that means is, should these tariffs come out even just remotely positive, should the market get this sort of sniff of, well, actually, that is not so bad, okay, that does open the door to not just a small squeeze, but a significant squeeze. Why? Because everyone that's hedging is ultimately going to unwind those hedges. Okay, now the only thing that safeguards those hedges a little bit is, of course, the fact that there is also hedging for the PMI data this week, for the non-farm payrolls this week. So it's not like everyone is going to simultaneously cover those hedges, but ultimately we will get quite a number of those hedges coming unstuck should we see the tariffs news not being as bad as expected. Okay, now in terms of the tariffs, tomorrow Trump is going to get some recommendations. We'll probably get some leaks about that tomorrow, and then of course I wouldn't be surprised to see some Truth Social news come out, but the announcement is due for Wednesday. Okay, so again, it's in the later part of this week when we are going to get the real sort of definitive news on the tariff. So the market's probably going to remain a little bit nervous until that point, but like I said, once the news hits the markets, don't forget, the uncertainty is what creates the concern. Once they tell us what the number is, ultimately the market knows what to do with it. Okay, and that's why very often what you get is this sell the rumor, buy the fact. Don't be surprised to see the same thing this week, which is a little bit of uncertainty, a little bit of fear, high vol. Once we get the number, well, regardless of what it is, we then get the relief rally in the markets. Okay, now with that in mind, we're seeing a lot of these headlines about recession, the R word, the big R word. Well, look, if there is a recession, this is the one market you are going to see it in, and that's copper. Okay, copper ultimately is a very good barometer for recession, and obviously we do have a number of things going on with copper this year. Of course, we've got the tariff implications, and so we are seeing quite a little demand in the near term. But if we just look at that copper chart since the start of the year, it's not exactly a market that looks fearful to some form of a recession. Okay, now I appreciate copper's not the cleanest recession indicator that it perhaps perhaps was 20, 30, 40 years ago, but it's still a good enough indicator, and we can see that copper is pretty much sitting around those yearly highs made last year. Okay, so it's not really a market that is showing recession in full storm. I think if there is going to be a recession, you're going to see copper a lot lower than what it currently is. And so again, it just adds more volume to this idea that yes, perhaps there'll be a little bit of a growth slowdown in the near term, but in terms of the big picture, we're not quite anywhere near this sort of recession fears that some participants are talking about. Okay, with that in mind, to confirm this, we need to look at the consumer as well as, of course, credit spreads, because that will confirm this big R word. And if we move across the consumer, we can see that consumer discretionary, it's down 15%, but it's down with the general market. Okay, so consumer discretionary is not underperforming the general market. In fact, if you look at where S&P is today, it's at the equivalent of the lows made back earlier this March. Okay, so the consumer, or at least consumer discretionary, is, I wouldn't say outperforming, but it's at least matching what the indices are doing. Now, that does not point to a recession. If you're in a recession, consumer discretionary is the underperformer. Okay, so keep a close eye on that. If we suddenly start to see, after tariffs this week, into the April month, suddenly you start to see consumer discretionary lead to the downside, fine. That's telling you consumers are tapped out. That's telling you consumers are dead in the water with these higher tariffs. That's telling you a number of things, okay? But ultimately, right now, we're not quite there yet. Okay, so again, just keep in mind the market is running ahead, ultimately, of what some of the key sort of data points are telling us. Okay, and then, of course, if we're going to have a look at those credit spreads, there's definitely something to view here, and this does look quite interesting. What we can see in the orange is, of course, US 10-year price, and we can see since the mid-February, since we started getting a little bit of uncertainty, we can see those prices have rallied. They've now staged a flag. Okay, we can definitely call that a nice flag, and we can see that at the same time, credit spreads, high-yield credit spreads, are somewhat offered. Okay, so we can see that spread is moving quite wide against each other. That is a sign, a little bit of nervousness, a little bit of distress. You know, investors are demanding higher yield to own junk bonds, but right now, ultimately, we're going to need to see this 10-year break above that February high, and at that point, yes, if the spread continues to widen and those credit spreads do continue to move out, that is going to ultimately send the signal that there is the slowdown coming in. Now, of course, it depends on the degree of the slowdown. It depends on a number of different things. Okay, keep a close eye on the credit spreads. You'll read quite a few articles about them. But what I want to just showcase and why perhaps this time could be a little bit different is if we go look back at last year, 2024 July, that's when we had that real sort of concern, that recessionary fears off of the August non-farm payrolls. You can see that the 10-year prices bid up very aggressively. At the same time, junk bond prices sold off very aggressively. However, it was kind of like a one and done. Okay, the 10-year yields collapsed back down, and of course, junk bonds rallied from that point. Okay, and then of course we did have the 50 basis point cut in September. Now, the reason why this time is a little bit different is because notice we had that initial move in Feb, we've maintained that move, so we're flagging. Okay, the market's holding this pressure to the upside, same with the junk bonds. Okay, we initially sold off, we're now holding on to that sell-off, and so this time does feel a little bit different. The market is quite nervous about this, and so normally what this means ultimately is that it's not that we're imminently going to run into recession, but it does mean it's going to take a number of weeks or months to get this whole thing to turn around. Okay, this is seemingly a theme that is now developing, and for this to change, you are going to need to see quite a number of things happen over the course of the next couple of weeks. Okay, with that in mind, like I said, it's a very big week this week. There's a number of data points. There's so many things to get through. You're going to have to keep nimble. I think that is the key theme for this week. You know, don't overcommit on Monday. It is, of course, month end today. We move into the first day of the month tomorrow. And then, like I said, there's so many data points, so many volatility, so many concerns out this week. For us as day traders, just trade what you see. Don't get stuck in this big picture narrative, whether it's a recession or not. All of that is mostly irrelevant for us. Okay, trade what you see on the tape. This week is going to be very opportunistic for us as traders. Now, with that in mind, if there are any other questions, do post them in the private Discord channel. Otherwise, good luck out there today. Go manage the risk. Go make some money.